Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint. All right, welcome back to another episode of the Breneman Blueprint. I have a very special repeat guest, Andrew Dunn from VAC Development. Now, if you didn't hear sort of Andrew's first episode or his story, that episode came out February 20th, 2024. So go check that out because we're going to probably end up skipping over most of that and just kind of launch into more current events, what's going on in Andrew's world here. So, Andrew, welcome.
Hey, nice to be here, Drew. Thanks, man. Good to be back.
Yeah, really enjoyed the last podcast we did, and then kind of always any conversation we have is fun. And we were just talking about the equity raising environment, and thought, why don't we just do this one as a podcast? Because you got a lot of interesting stuff going on. I think I might have skipped over, I guess, what you actually do. Where I said check out that other episode for the full story, but just high level, you do commercial development, shopping centers, retail pads, industrial. Looking at office deals.
Yeah.
Anything I'm missing there?
No, pretty much sums it up in like the basic element of what we do. I mean, really, we're deal junkies, we're yield chasers, primarily focus on the Southwest and Mountain West markets, and then also have some stuff working in Florida with a sister office of ours. But that's really it, man, dude. It's industrial, flex and, big box distribution warehousing. It's the pad developments, shopping center acquisitions, office conversions or just office acquisitions, really anything all commercial real estate. I really have kind of niched down into wanting a lease in hand. That's more of my thing, and it's easier to take that to a bank for financing right now in this kind of volatile capital environment.
Why don't you unpack that a little more? So before you were buying a lot of vacant properties, or you'd be fine buying it before knowing who the tenant would be. Now what are you focusing on?
You got to have positive leverage going in to some level. So the institutional equity or the JV equity that's going out there, the number one thing I hear is having neutral or positive leverage year one on your year one NOI. Now, does that change the envelope when you have a heavy value add component? Yeah, of course, like getting positive leverage on a 25 or 50% occupied asset is very challenging. But if you have something where you're doing a mark-to-market play, meaning, hey, the rents are 20, 30% below market, and in 2 to 3 years, I'm going to casually raise them back up to market value, depending on whatever I do with the asset. And that's where you really see the neutral or positive leverage come out. And that's where I think you've seen transaction volume falling off a cliff in the last year or two in commercial real estate, specifically, whether it's industrial, retail, or office. And it's just because these guys can't make their spread on the debt. Leverage you used to be able to get on a spec industrial building going up in, 2021, you're hitting 70, 75% loan to cost. We just secured a debt placement for about 26 million on our warehouse development up in Reno, but it was 58% loan to cost. It was with a life insurance company. And I think you're just seeing a lot more conservative thought processes. And because nobody knows what's really happening with rates, it's like one day, oh, hey, we're going to have 3 rate cuts. And that's like, are we even going to have one or none throughout the course of the rest of this year? And I just don't think anybody is wanting to play the guessing game anymore. And everybody's thinking that we have to price in that rates aren't going to go down in our foreseeable horizon periods when we're taking on these acquisitions. And that's what we're really getting in from the feedback from these equity groups.
Yeah, and just when the eventual whatever rate cuts, interest rates drop, that's a sort of upside baked into the deal.
No, I mean it is. It's that's the basic upside of the deal, and it's like this is the biggest challenge is like how do you even forecast a cap rate? And it's like these days where people are like, oh, I'm selling sub five. If you put a five cap in front of any institution or anybody, they're gonna either think you're smoking crack or you don't know what you're doing, or you better have a really good competitive set that justifies why you're throwing on such an aggressive cap. Because anybody who's buying that cap rate, you either have to be giving somebody a value add opportunity where they see market rent growth and are taking advantage of that, or it's just some trade guy which doesn't really exist unless it's a single net leased asset. For maybe a Starbucks, the Chick-fil-A's, the In-N-Outs of the world, but otherwise, you're going to have to give people more yield, and I think you're going to see yields continue to expand. Like perfect example in the single net space, which we're pretty active in several markets in several different sub-retail asset classes, transaction volumes down to its lowest level in 14 years. And the volume was like a little over a billion in 2023, but just 3 years ago, that number was 11 billion. So the market just dropped off a cliff by over $10 billion in 2 years. So yields will have to continue to go up for capital to be attracted to go then and redeploy into those assets again.
Yeah, and something that's interesting too to compare to 14 years ago, because that's about when I started doing larger deals. So in 2009, so a bit a year or two before that. But
Yeah.
we were buying deals similar to what you're talking about, where it's multi-tenant retail. Usually it was either, we'll say 80 to 100% occupied already, because we wanted positive cash flow. And then we were oftentimes buying the only sellable deal that developer had at the time. So then, and we were, I mean, on most of these deals, we were the only bidder, and no one was even faking like there were other bidders. It was so bad out there. But I always tell people this, the big difference back then was for like a small shop retail deal, we were buying at like a 9 cap and borrowing at a 6. So we
Oh,
still had huge positive leverage,
yeah.
and we would be over there going, is 15% cash on cash day one on a 25-year AM schedule? Is that enough to, I mean, it was really bad though. It was where that was a legitimate question, and how we
Yeah.
got over it was we would think, okay, let's say it's, okay, it's 15% plus you're paying the loan down to get you to maybe, let's say, all in 20%, just simple guy math,
Yeah.
annual return here.
Yeah.
Well, the lease is for 7 years, and at least in 5 years, we'll have our
Money
money
back.
back. Yeah, including the principal pay down. And so if it's worth the same thing in 5 years, I mean, at least we know we're not losing money, and then we
Yeah.
have a ton of upside,
Yeah.
obviously. And yeah, lo and behold, like on a lot of those deals, we've 4 or 5 timed our money without even selling them yet. Just
Yeah.
where the rents have now gone up 50% on a lot of those deals, and we've refinanced out all of our equity and then some. Because then I was looking back where, yeah, a lot of those were in at like a 12 yield on cost now, and locked in debt in 2021
Oh
in the threes.
man,
So,
dude. Never sell
um,
it. There's no reason to.
but so I don't want to get too sidetracked on this, but this is it's very different now, because you go, okay, it's a challenging environment, maybe not as challenging as 2009 and 10, but still the worst time we've seen for investing since then. And it's like, what are cap rates today? 6.5, 7, and you borrow at 6.5 or 7. So you're not really getting that, like those returns that are compelling people off the sideline either.
Yeah.
But if it's anything like the 14 years ago, if you can buy anything now, you'll end up crushing it, because the whole market is at a big imbalance right now. And so potentially every deal has asymmetric return potential relative to the risk, because the whole market's depressed.
Yep.
But it's hard to make that make any sense when you go raise equity, because in order for it to pencil, you got to assume cap rate compression, and everyone looks at you like you don't know what you're doing if you do that. So,
Yeah. Well, no, I
but
think the biggest thing feedback, just to go on the cap rate side of things and the underwriting, is if you're buying something even at a 7.25 or 7.5 cap, right? But my exit cap in year 4 or 5 is a 7. Like we had one of these where we're buying, mark to market center. The walt's like 3 years. The size of the deal is about 50 million, 235,000 feet, about 39 tenants. And the biggest question is like, well, you're buying it at a 7 too, but you're exiting at a 7. And I was like, you're really questioning me over 20 bips, but I will have a 5+ year Walt asset when I exit this thing in 5 years. And that's just the level of scrutiny that operators like myself are going through right now. And you're getting a lot more of these critical questions. Now, if I would have told you that 2 years ago or 3 years ago, or even a year ago, nobody would have batted an eye at that. And they're even forecasting now more cap rate expansion in their models. So you're either at or above higher cap rate exits today, or you're underwriting at cap rates today, but you have to forecast 5 to 10 bips of expansion every year you hold the asset. So everybody is getting more conservative and they're questioning all of your assumptions. And before, everybody would dive into a deal, money just doesn't come for free, but it was a lot looser and there wasn't as much anxiety as I am seeing and feeling from these different operators. And I'll also kind of touch on something real quick. You said something when you looked at a deal and you're like one of the only bidders on this deal. 2 or 3 years ago, you go and present a deal to an equity group or your investors saying, I got this deal off market, right? Off market's relative to what market you're in, but it's not listed on CoStar or the listing service that's in your area. People are thinking you're getting a good deal. Now, if you get a deal off market, people think you have a crappy deal. And I think the deals that will continue to come and be advantageous to yield chasers or value add guys or discount buyers are going to be the deals that had a broken process ran by the marketing group. Whatever national marketing group runs a process, the 2 to 3 months, and they don't get to the guidance that they offered in their listing to get the listing, you're going to see, pending on the stress position of the owner, that's where you're going to see the deals be made. So be patient. My advice to anybody right now is be patient, stick to your underwriting, stick to your metrics, because we've had several deals where we gotten beaten out by a couple million or a few million, or in percentage terms, 5 to 10%, which, is a lot of money when you get down to it on these larger assets. And then 2 months later, they never actually put up the EMD and got to a PSA, or their funding never went through because exactly what we said earlier, they were underwriting under the pretense of negative leverage. So they're just not paying attention to the capital on the market unless they're internally capitalized or they're an end fund guy, who's doing their due diligence or their acquisition that I can't compete with because we use, a decent amount of leverage whenever we take something on. We go at market or above market in leverage terms. And, we're 3 to 5 year holders. We're not really typically your 10-year hold guys right now. So that's just kind of what I'm seeing out in the market.
Yeah, and I can echo that, at least on the on people getting deals under a contract and then having to blow out, because I've saw deals come back around and interest rates went up so much, so far in 2024 that you can understand why, where you go, okay, I'm buying it, at least use apartment interest rates. The start of the year, or at least 3 days before the end of the year, we did a Fannie loan, 5 years interest only, 5.53%.
Nice.
And now that same loan is touching 6.5%. So things moved a lot. So if you had had a deal under contract in that time, maybe anyone would have had to blow out with how much interest rates moved. And but to drill down, why are you thinking the off market deals are potentially the worst deals right now? Is it just because it was so overpriced no broker would take it on, or what was the thought process on that?
I think there's a piece of that, and you're also trying to force that you maybe have a distressed acquisition, but what's really the reason that somebody's selling? Like, if transaction volumes are depleted like they are, depending on your asset class category, they're down anywhere from 60 to 90% from their peaks, and values reset when there's more deals than there is capital. And so then yields have to expand to get capital attracted to those deals. If somebody doesn't want to list their property right now with a broker that they know that can deliver, then they're looking for the schmuck that's going to approach them off market and is going to run the process with this potential prospect to see if they could actually pull one over on them. Now, am I saying that is the instance and case in every off market deal? Of course not. Some people want to keep things more close to the vest. They don't want to actively market that they're about to lose their butts on an asset, right? That's not a thing. You're like, oh, hey, I bought this thing for 10 million and now I'm selling it for 7. That's not going to be a good look to the investors and try to get out of your capital. And it's like, oh, does this guy even know what he's doing? Does this office or group even know what they're doing in this instance? Or do they even have the capital to redeploy after this thing sells? So I think people want to keep things close to the vest. That's the reason that you can overcome that. But the truth and kind of more clarity behind my statement is it's more about why do you think you got that off market deal? And it's the same thing in any capital raising journey. What's your story? What's your story behind the deal? Like, oh, I know Drew. Drew's like, I don't really care about this asset anymore. He's a local owner guy in Austin, Texas. Well, Andrew doesn't. Andrew sees where Austin's going. Drew's been in that market for 10 years. He's too close to the market. Andrew sees where rent growth is going, supply is limited and everything. And I have more of an opportunistic story to garnish the capital with an off market operator who just doesn't want to blast and run a process. So again, I think it just comes back to the story, but more and more what I'm hearing when you try and look at these off market deals, like I'm seeing my inbox has been flooded with deals more in the last quarter than it has been in the last 2 years that are even worth anything. And most of them are broken shovel ready developments that only functioned under a 3% interest rate environment. And the replacement costs haven't gone down. Everything has been thinking construction costs were going to go down, and I just don't see it. So we're just getting a lot more off-market development deals than ever, and the numbers straight up do not work in any of these markets we're looking at.
Yeah, I just wanted you to unpack that because I think
Yeah,
that there's always a lot of nuance in these things. So that's
100%.
great. Why don't we dive into the equity raising then? I mean, you've been, I know, in front of a lot of investors in 2024.
Yeah, so I'll answer the question with a story. A couple weeks ago, I was at this conference called the IMN Distressed Asset Forum for Commercial Real Estate, and it was the West Division, and it was in San Francisco. So it was just all about distress and all about capital raising and finding these different, middle market equity groups that write these 10 to $25 million checks for your deals. And it was really funny because at the end of the conference, there was a couple guys that were basically like, everybody wants distress, but nobody even knows what distress is. Like, if I were to ask you what your purview of distress is, you and I gave you mine, we'd have some overlap, but they'd have differences. And it's not so much the focus on distress, it's more of the focus on opportunity. And really, where is the opportunity and value and arbitrage that you're creating that other operators and investors don't see? The biggest thing that I'm seeing is going to be the hottest ticket is inline shop retail that's like 15 to 100,000 feet. So unacred strip centers, regional strip centers, that's where everybody is really kind of garnishing up their yield for in the safest way possible because the rents haven't really skyrocketed since like the last 2 years. So it's really where flex industrial was 5 to 7 years ago, where the replacement cost disparity versus where the second, third gen spaces are, is where the opportunity lies to this investor capital. Now, going back to what we discussed earlier, can you get neutral or positive leverage on your in place acquisition to get that capital attraction? So the biggest thing that I'm seeing from capital is you almost just want to say there's a distress trigger when presenting your opportunities so that but the potential capital partner that you're talking with opens your email and takes your phone call. But the craziest thing is nobody knows what the distress really is. And I think what capital is really starting to look for is just making sure that they don't screw up their investors, but they also have to deploy their money. So the biggest thing and takeaway that I've gotten over the past few weeks after all the Q1 data's come out is how well do you know that submarket? What is the supply coming online in that submarket? Why do you think you can create yield or your alpha above what you're getting compared to everybody else? And people can't start Fund 18 without deploying all the capital from Fund 17. For example, let's just go to the number one, 800-pound gorilla in commercial real estate, Blackstone. Like last year, Q1, I think Blackstone raised almost $2.5 billion in Q1 in 2023 for distressed real estate. This year, they've only raised about 230 million. So even Blackstone's capital raising efforts have fallen off a cliff. And the reason being is nobody wants to redeploy capital until their capital is recycled and knowing that it's getting spent because it's committed sitting in a fund that was raised 3 years ago. And they're going back to them for more. And they're like, we don't have any more. We've already allocated our capital to you guys. And there was a report that came out by Cornell. It was about a couple weeks ago. And it basically took 175 institutional capital groups across the world. 70% of them were in the United States, but these pension funds, retirement accounts, these traditional equity providers to these institutional operators have kept a standard of about 10% of their funds allocation towards real estate. That's gone up from like a 7% allocation in 2014, but it's flatlined at 10.8% over the last few years. And the reason being isn't because they don't like real estate anymore, but it's they're looking for the alpha. They're more focused on the core plus or value add opportunities. And you're seeing just a lot more conservative underwriting, like we discussed before. So capital raising for equity takes longer. They want to see you have the deal locked up before you kind of present to them, which is hard because guys on the seller side, because things have been so volatile, have been wanting more of certainty that you're going to close and where is your capital coming from. It's not just like, hey, I'm a good operator, I have a great closing track record, here's my executive summary, here's my track record, I'm going to close this deal. They're like, no, dude, who's your capital? And that's been our hiccup in a couple of times is we can't lock up certain deals unless we have a soft commitment from an equity provider, but the equity provider doesn't want to dive in or give you the soft equity commitment because they got 100 deals in their inbox on Monday from Friday, and they're just scouring and they don't want to waste their time with somebody who just says they're going to lock up a deal but doesn't have anything because everybody's just trying to find opportunity in their own alpha to hit their fund metrics. So the whole real estate institutional equity raising side is in a weird place right now because people are trying to save on the distress that they're having on their own side, like Brookfield and like their LA office towers. Some of these multifamily syndicators have gotten just kind of hammered because of the floating rate debt scenario, and people are in this weird time where they're losing money in one side, deploying money to make more money on the other side, and they're also all being conservative. They all have to deploy money, but they have to deploy it in the right opportunities, and they have to hit their certain fund allocations. And you have to look at these guys saying how much more equity in this fund is available for industrial, how much more of it is available for retail, how much of it is available for multifamily, self storage. And that's where you have to play the game and keep a pulse on all these different equity groups and understanding where their allocations lie. It's not really so precisioned anymore as it is much as a combination of precision to your core groups that you can work with and can work with your strategy, as well as having a shotgun and what I call a spray and pray to hope that somebody didn't allocate enough money towards a development deal or a value add deal or a core plus deal and being able to be like, I got one. I know you need to spend your money before you start fund 20 or else unless you deploy this money, you're not going to get your money from Fund 20 because you're just going to be known as a capital committer, not a capital deployer. So that was a lot.
No, yeah, no, it was, yeah, and that's very interesting to hear because that's obviously talking to a lot of these groups to be that in the weeds on how much they've got out from what they've committed. So then, what have you been doing this year? Let's say in particular, then to raise money. So that's obviously a more institutional investor focus. Bring us to
Yeah,
current day on how you've raised capital, and then more specifically in this market, what you've been doing.
it changes every month almost at the end of the day. I think the more thing that we've realized is focusing on acquisitions from 20 to 50 million because that's where we see the most liquidity from these funds. I'm not a syndicator. We've done it a couple of times for more friends and family. It's great. But the work that you have to go through on these deals in today's environment is a lot tougher. And I'd rather deal with a single sophisticated check writer rather than trying just to get little pockets of money. Because even the syndication side, I can feel from our investor base, that capital is tightening, and they're tightening for their own projects, right? Like our investors are all typically business owners, or they have been business owners, or they've been investors themselves, and they usually aren't retired. They're more active people who have their own other opportunities, and they use you as a diversification tool for their own investment strategy. And what we're seeing is guys are being more cash reserve focused and not deploying that money just to be able to have access to it in case they have a payment issue with one of their vendors. So for us, the sophisticated investor might be more challenging to deal with, but they know the questions and know the right questions to actually deploy the money. So what we've been doing is looking for more like smaller deal guys, meaning like guys who don't have 100 people in their office. They operate with a team of under 10 people, and they're going to take your phone call. They're going to pick up your deal. They do about, 6 to 20 deals a year. They're not doing 50. And, they're typical check writers of like 3 to 10 million. And that's kind of, it allows you to do basically those 20 to $25 million deals that we really like to do that stay on that private capital side. So, for us, our focus has traditionally been joint ventures with family offices, but we've wanted to shift away from that to get more of a promote with some of these guys that are solely focused on real estate, whereas these family offices are seeing more distress in these different businesses as people continue to retire. And that's where they're trying to focus their capital and get out of real estate a little bit more. So for us, we are reverse engineering what the equity is looking for and chasing those opportunities that fit the equity funds boxes. And rather before it was, hey, I have a good deal, I'll get 5 or 10 term sheets. Now it's more of like, okay, you have 80 million you need to deploy, and half of that's dedicated to opportunistic value add like retail centers in the Southwest. Okay, so I'm going to go chase those opportunities and see where I can go find a deal rather than like, oh, I'm just going to go find this deal and I'm going to go find the money that fits the box for this deal. That's really not how it's working in today's environment. It's where do you find your alpha? How can you back up your alpha? And what is that equity have that they needed to deploy to get to their next fundraise? Because until they deploy that money, nobody's raising money. And we're hearing that across the board, across the country. Doesn't matter if you're a $25 million fund or a $2.5 billion fund. Capital raising efforts are down and people are being more constrained, and you got to fit their box, and it's more of a matchmaking process than ever.
And then how have you gotten to these groups then? So the $3 to $10 million check writers, what strategies, tactics, what have you done to get in front of them, meet them?
So, conferences. I'd say there's nothing better than going to a conference with a live deal. Don't go to a conference and not have a deal to talk about. If you don't have a deal under contract, a deal you're working on, or a deal where you can pitch them or be involved in, you're going to waste your time and they're going to find a way to exit out of that face to face meeting. Position yourself as a professional, but at the end of the day, we always are acquiring and we're always looking at different opportunities. Do they all get done? Of course not. Something happens in the process, especially in this environment. And for us, you got to go to the conferences. We've been pushing stronger efforts on LinkedIn and Twitter or X, whatever you call it. And I've actually found a few of these guys from just posting online, or guys that like just I post online. They're like, hey, I got a buddy who has a fund, or hey, you've been very active. Like, you got any deals? Like, I just had a deal fall through and I got to deploy 9 million. I literally had that happen to me on Friday, and we're having this on Monday. I had a guy basically say to me like, hey, I know we haven't talked in a little bit. I've seen what you've been posting online, what you've been talking about. It seems like you're keeping a good pulse on the market. You got any deals? Like, I just had a deal fall through and I had this capital committed and I can't go raise my next 50 million until I deploy this 9 million. And I was like, hey, I got a deal that needs like four. Would like, here it is. Here's what's going on. And we're talking later today about it. And so I think you just, again, keeping a wide presence and becoming an expert in what you're doing will help you, but nothing beats having a live deal and going to these conferences, because all these professionals, it's just like the country club theory, right? Like, surround yourself and position yourself to be around these people. and they're going to talk to you if you provide them value and opportunity.
And then specifically what conferences?
I'd say the number ones that I like are the IMN series. IMN that just attracts real estate professionals. And listen, these conferences aren't cheap. I think for a 1 day conference, the thing was $1,000. So it's like if you're spending $1,000 for 1 day, you're going to be around more quality people than the 3 day seminar that costs $1,000. And might be more catered to the novice group that's just getting into real estate. So it's again that country club where you pay to play to surround yourself. And basically by being there in that presence of that conference, you're showcasing, I'm serious about what I'm doing. This isn't a game to me. This is my lifestyle. I think another avenue is contacting equity brokers. We have like one that's local to us in Las Vegas. We have a guy out in Brooklyn. We have groups out in LA. And depending on what other of these opportunities we're doing, we'll run a capital markets process like we have done with Walker Dunlop, who's a capital markets organization, very renowned, does deals internationally. I mean, at one point, I think they were doing 100 million a day in deals. They weren't like 100, not 100 million in revenue, but they were closing 100 million a day. And I was like, that's aggressive. Like that's just an insane. So they have such a strong pulse on the debt and equity process. We've used them for our Reno industrial spec development, and they got us to a great life co lender. We're in talks with several equity groups, and it's just like finding that way to close them up. But again, the process has been a lot longer. So my advice is show up to the conferences. IMN is a great series of professionals, or what's niche to your group. I know for you for multifamily, there's usually the NHMC, right?
Yeah.
Yeah, NHMC and going to theirs, like you'll find equity there. It's just how do you approach the conference and researching the groups ahead of time to be like, hey, Tim at XYZ Capital or XYZ Fund, like, you have 15 to 30 minutes to talk. I got an opportunity. I think it will fit your box. I'm an operator based in Las Vegas. I do X, Y, and Z size of deals. And like, when you come at it with a very methodical and detailed, precisioned approach, you're going to get 15 minutes. And let me tell you, if you can't sell your deal or talk about your deal in a 1 to 2 minute time span and think that that 1 to 2 minute pitch doesn't create value for somebody, then you're not going to get money and you don't know how to sell your deal. So that's what I advise people do. Like ICSC for retail, you're going to find people. ULI, great pulse for people who love data and operate and who want to understand the market on a high level. NHMC for multifamily. SIOR is traditionally more brokerage oriented, but you'll find deals and you might find a capital source or two. IMN's are great. And I think, or CCIM, not so much. So it's really kind of where deals are being made and where these fund guys want to learn and see more of a pulse on the market. Those are the conferences I recommend. Just look them up. And this is how like IMN does it. They'll show you the attendee list. They'll be like, oh, we got these 500 people. Look at all these names. And you'll go down the list. If you're in the game, you'll recognize names. Like, oh, you'll see Blackstone on there. You'll see like an Argosy, a Blue Vista, this institution. You're not seeing the pension funds, but you're seeing the funds that connect with the pension funds. And when you read through it, you'll start looking at, go friend them on LinkedIn, go send them emails, find their contact information, have your deck with you when you go. And so you can present something to them like you're doing on a road show. Again, like how do I get you captivated into what I'm trying to sell you and partner with you on? That's my recommendation.
Yeah. And then specifically for the IMN conferences, so they have Laguna Beach.
Mm-hmm.
They have another one somewhere in California.
Yep.
These are primarily focused to the private equity family office. My understanding is they have 2 on the West Coast every year and then 2 on the East Coast.
Yep.
But they had this one in Miami that we went to last September, give or take. And then they do one somewhere in the Northeast. Is that those conferences? Is that what you're thinking of?
Yeah. So my favorite conference that is now a staple to me, and it's ironic, it's actually pretty sweet because I grew up in Laguna Beach and the best one's in Laguna Beach. And it's the private equity family office forum that is usually like right around MLK weekend. It's like either the weekend before or the weekend after. It's for like 2 or 3 days. And it's very funny. Like it's the most profiled thing I've ever seen. It's just a bunch of white guys in blue sports coats and like sometimes jeans and gray hair. And then they're young cohorts. It's literally like hundreds of those guys. And you're like, I see why people stereotype this industry. And
Yeah.
that's the one that I go to. And then yeah, the Miami one's really good. There's one in New York, and then there's usually like one in San Francisco or LA. But I'll tell you what, the IMN series is really good because you're exactly right. The hotels aren't $100. Not like there's not really, you can find the Holiday Inn, but the one in Laguna Beach is at the Montage, where it's going for 500 a night. They'll give you like the 10% room rate discount by joining the conference, but it's not a cheap place to go, and you're not spending a little bit of money. But like if I were to tell you, would you spend $1,500 at the chance to get 15 million? You'd be like, yeah, where's my money right now? And it's the best marketing you can do. It's ironic because it's even like going to the gym. Like I go to Lifetime Fitness, it's like an Equinox style, it's like a lifestyle gym, and people always tell me like, oh, you spend $300 on a membership a month, and I was like, yeah, but okay, let's do that. $300 a month, times 12, 3,600 a year. But I met my partner at Lifetime, and we've made a lifetime of Lifetime memberships by partnering up and meeting at the gym. And he's one of the most notable people that always goes to the gym to go and make money. So it's shifting how you think about those daily like expenses and what you do, and shifting them to where you can provide value and capture, your end result to help you hit your end goals and what you're looking to do. And I think like reworking that's not about billboards or magazine ads or anything else. It's about, okay, if I spend the 50 grand on the country club membership, how many investors do I need to recoup that cost? And it's more of a marketing cost than it is a lifestyle cost. I'd say
Yeah,
that.
and just wanted to be clear on which IMN ones, because they
Yeah.
they have the whatever Southeast Multifamily Forum and the Texas Multifamily Forum, and I mean, sure, there still will be some equity there, but it seems like these four or so conferences I'm talking about now, there's a lot of them there, whereas in your average IMN one, it's a lot more operators, brokers, lenders type. So
Yeah.
just want to unpack that a bit.
Yeah. You got to
Then
look for the
have
family offices, but go ahead. Yep.
have you been doing this then all on your own, or I think at one point you were maybe you had hired someone, or how have you been actually executing this?
So the guy that we hired, we fired. We let go because he didn't have the technical equity experience that we were looking for. He was more structured finance. We're bringing somebody else on, but dude, traditionally it's just right now it's all on our own. It's all on our own, or it's through a third party equity broker where we go and engage, and you pay that person 2 to 3% of the total equity dollars you raised, and it's a deal cost. And you do your best to get them that number, but sometimes it gets worked down by the different equity group because a 3% equity check on $10 million is $300,000, and that is a significant line item in the deal. So they can get pushed down by the equity provider they connected you with, and that's why you don't typically see a lot of equity brokers out there like you do the debt brokers. I think if you're looking in the capital market sector, I'd say probably about 80-90% of the people are debt focused, and then 10 to 20% are equity focused. And even though when you look at checks on these deals, the equity makes way more, and it's because it's way more of a challenge and it's a dating and marriage process. So if you like, let me make this clear in the equity raising process. If you think just because you're a seasoned operator that you're going to go lock up a deal, and because you think you have this great track record and everything, that you think you're like a AAA rated operator or developer, and you think you're just going to get 5 to 10 term sheets in this environment, I would strongly consider you to rethink that process. Everything's taking longer from just even the dating phase of like us talking online to us meeting in person to us getting a term sheet. Like, it used to be probably under 60 days of like dating to get like kind of worked with an equity group. I think it's more like 120 to 180 days, and you sending them 3 to 5 deals because they want to see you're consistently churning these opportunities to see if they could actually build in a programmatic relationship with you. And I think that's a key that a lot of people don't realize is that they just take the best term sheet for that deal today, not who's going to be the best partner over the next 3 to 5 deals that I do. And when you're doing more, the heavier check sizes and the higher single digits or double digit range, you got to realize that these people want programmatic relationships. They don't want to have to consistently negotiate and operate an agreement to get a deal done. They don't want to consistently have to vet the sponsor. They want to say, wow, we vetted the sponsor and we just want to be their first choice when doing a deal. And, you give them a win, they give you a win. You got to negotiate wins all around. You got to take it on the chin a couple of times, and so do they. And it's just creating that partnership together. It's a marriage. You're not in real estate deals with these groups. They're not like, oh, thanks for the money. I'm just doing this swing trade real quick and I'll get your money back in the next month. No, these are marriages. They last 3 to 5, even sometimes 10 years, especially on these development deals where you're not even making them money for 3 to 4 years, right? And so again, you have to have more of a long-term focus when you're doing these institutional equity deals, because the number one thing they ask you, who's your team? How many deals have you guys done? Have you guys ever gone through a recession? They're going to poke holes in your entire investment thesis, and you better have answers. And if you don't have the answer, say, hey, let me check with my team and get back to you on that. That's okay. But it depends on the level of the answer. That's like, oh, what's the square footage of the building? And you don't know it, then you're going to look like a schmuck, but if it's like, hey, like, what do you know about this tenant's financials? Like, can you tell me about the previous deals they've done or their other locations? And if you don't have that answer when you're talking to an equity group on some sort of level, you're losing credibility because you didn't do the deep dive on the deal. Like, I'd rather do less, and this is where our group's more focused. I'd rather do 3 deals a year, maybe 5, but they're sized between 20 and 50, than do, 15 to 20 deals under $10 million. I might be more diversified, but I'm actually positioning myself into more of an allocation. I don't like to have a certain allocated asset class. I like the diversification of being in different markets, different asset sizes, and just different asset profiles and businesses plans that overlap to each other, to where I could maybe see some arbitrage that others don't see because of just our wide exposure.
And I think maybe we want to make sure everyone knows the term. So when you're talking about having a programmatic relationship and people looking for that, what are you talking about?
I mean, I'm going to do several deals with that person. I'm not just a one and done, like, oh, thank you for the money. Let's go do this deal. I returned your money. I'm done. It's no, let's do one and let's work together over the next 10 to 20 years. They want to see that you're going to last and that this is your career for your lifetime, and you're not just some playboy trying to get their money. So they want you to see that you're committed to the game. Do you have corporate governance? Do you have incentives for your employees, even down to the analyst? Does your analyst have a carried interest position in this deal? Your asset manager, your accountant, your operations? Why are people involved in your partnership? What type of culture do you have at your firm? And I think that goes a longer way than what people realize. And they think like, oh, here's my deal and this is it. It's not just about the deal. It's more about you. Like you hear this from a guy named Gary Vee, very prominent, in media, has a, mixed personality. And he talks about an investment strategy that I hear through everybody, through a lot of seasoned investors. It's like when you're giving money, the focus is really 70% on the operator or the founder and 30% on the deal, because a good deal is a good deal, but the operator is what can really push the returns and secure the business plan up because of how much they know and what they do and their commitment to the game.
Yeah, that's great advice, because a lot of the LPs, even individuals, or a lot of them that really are experienced, they talk where first they want to vet the sponsor before even diving into the deal. Like, if you meet them at IMN or something, you got your deal printed out, they'll say, okay, why don't you tell me about you and your company first?
Yep. Yeah.
Because if you just started yesterday, they'll be like, hey, cool, actually, I'm getting a phone call.
Yeah. No, that's what they do. They're like,
use the
oh, next
bathroom
meeting.
here.
Yeah, they're like, oh, next meeting, like, oh, I'm in a rush. And so you have to have your pitch down. You have to be able to sell yourself. Like 3 minutes is the higher end, but 1 minute, like your prime time. Like, and so it's like 1 to 3 minutes. Like the biggest thing that I say is, because I'm 28, like I'm very young in the game, is I have a 68-year-old partner who's been doing this for 40 years, since 1978. And he is my gray hair. He's my balance sheet. He's my mentor. My second partner is 38 years old. He's been doing this since 2003, comes from a legacy family asset. We all have different perspectives. We all position differently in the company. We all provide different values. We're all committed to this. Like I always say, the joke, like the 68-year-old, he's doing this until he dies, or at least I'm making sure of it. Like this is his lifestyle. And like the deal guys that I know, it's a lifestyle. Like there is no escaping. Like you're just in it, man. And whereas like some people are like, oh yeah, I'm gonna retire. Like, dude, I know guys at 83 that are doing more deals than guys under 40. And it's just because like if they don't do it, they're gonna die. And so like you got to be obsessed with it. When you're obsessed with it, people can feel the obsession. When you get like, oh man, freaking 10-year treasury going up 50 bips in the last 2 months, can't forecast crap. Like, what are we going to do here? Or it's like, you like reading paper. Like, what do you read? Like, one of my favorite things I ask people is like, what's the last book you read? What's the last thing you read? Like, was it an article? Like, are you reading freaking like a Bluey novel to your kids? Like, or are you reading some empirical evidence, some CoStar article, some BizNow, Wall Street Journal, Bloomberg, whatever? I find that stuff fascinating. So like for me, I'm a data citer. So like I cite numbers and figures and facts that I know people either have heard so they can validate me easily. Like the 14-year like lowest single net volume history, that's been a very cited thing in retail. And so when you say that, but then you have to have a backup article underneath it. So it's like, yeah, okay, 14-year lows. Well, why is that? Do you take a deeper dive into the data, or do you just read the headline clickbait article and data set that got you to open the article? Like, why is that? Well, it's because trades are down. It's because interest rates have risen. Because, oh, people can't get positive leverage and they can't, do the 1031s as easily anymore, or more retail because prices have gone up. They're over 3 million, where, over 50% of the trades in retail are under 3 million because they cater to that contractor who just sold his business, just sold his house, doesn't want the house. They want the single net Starbucks deal. And you have to just have the obsession to get the money. And I think that's more true than ever today. And even then, you will still have a struggle. And you just have to kiss more babies, shake more hands, show up more, dress up more to get the same thing you got 2 years ago.
And so when you go to these, when you're pitching equity, then, I mean, what are some things maybe you haven't covered, the tips? What would you advise people? Let's say they haven't done this before. What do they need? They need to have their deal ready to go and explain in a couple minutes.
Yep.
Your company story in a couple minutes. I mean, what else should they be thinking about?
Yeah, so let's just start from the top. So you got to have your company overview. So an executive summary plus your track record. You need those two things. Your track record doesn't have to be detailed to, case studies and everything, but case studies are also good to have. In our executive summary, we have a paragraph of who we are and our history. Simple. Then we have some of the partners that we worked on a contracting, brokerage, or finance level. Then we have 6 to 8 case studies of deals that we've done together that like really kind of showcase our brand and our operational history. And then we basically have an Excel ledger of the amount of multifamily units we've done, the square feet of commercial, office, retail, industrial space that we've done, the years that we did it, when we bought it for, how much we were in it, and then what it got out of it. The best scenario is the actual IRR to the investor, and based on what you underwrote versus what you actually delivered. That's a big detail. Like the more detail, the better. And then when you look at your deal, it's having the comp set available. So right now we're doing KMZ files with Google Earth a lot more when doing comps because it's easier. So rather than just doing a PDF, there's a file, it's called .kmz, to where you can create on Google Earth little oversights with notes. So it's like, oh yeah, that little comp right here sold, December 2023, this cap rate, this broker represented the buyer, this seller was represented by this broker, and have detailed interactions like about your comp set. And it's not just like, oh, here's this comp. Well, it's like, what do you know about that comp? And you have to actually understand the comps on the leasing and sales side to justify your underwriting. So every assumption that you have in your model better have a story behind it. Why am I putting that cap rate on? Why do I think I can get that rent? Why do I think I can execute that value add strategy in that certain amount of time? How do you know that's how much that CapEx requirement is going to cost? Do you get one bid? If you got one bid, why do you trust that one bid rather than going after 3 other bids for the contractor? Why do you think it's going to take this time? Why do you see this rent growth happening? What do you know about the coming on supply? Like, how long have you been operating in this market? How well do you know this market? And like, how far do you live away from this potential opportunity? If you're saying you're a local operator, who's owned this deal? Why are they selling it? You have to understand every detail. And the more details that you know off the cuff really quickly, the more capital gets comfortable, and you'll know if capital is interested by how quickly they respond. If they're not responding within 24 to 48 hours, they're lightly kicking the tires on your deal. It's not the deal they love. They might like the deal, but you got to hook them in. It's like you're going out to the bar and you're trying to find a chick to go take home. right? Like, how many of those girls do you have to talk to? You're not going to just walk into the bar and the first girl you talk to, you're going to take home. No, you might have talked 3 to 5, maybe even 10. Might be there at 2 a.m. But the guy who remains the longest will eventually go home with something. So be in your process when you lock up a deal. If you think you're going to do a deal like on a 45-day D and a 45 to close, that tells me that you have capital in some shape or form committed. Otherwise, you need to extend your escrow timeline to 120 to 150 days because that's how long it's going to take you to get these capital relationships as a newer institutional operator.
And I think an important distinction what you're talking about is you're doing development too, on those timelines, because that's one struggle that I've had where, no one's letting you lock up an existing apartment deal for 150 days. So you got to be ready to close that in 60, maybe 90. So
Yep.
It's been very rare for us where we have an acquisition and then you're showing that deal the same way Andrew's been talking about the whole episode, and then that group on that first pass is like, great, I'm in and I'll fund in 3 weeks. Like it's such a long dating process, and as you say, and then it's very rare. I guess it has happened where they fund the first deal, but those
Yep.
are really small groups, agile. A lot of times it's you better have pitched the decision maker or actually the oldest person in the family at the family office. Like if you didn't get that person, it's pretty rare to do it. So I think that's an important thing to know too, where no matter what you're in, a lot of times the first pass, it's going to be a no. And then you were saying a lot of times they want to see 2, 3, 4, 5 deals to know you have the deal flow. But
Yep.
I think that's important to know where, like that last deal I was talking about where we had the 5.5% interest rate.
Yeah.
I've never pitched a deal so much where in a lot of these pitches, I know they're not funding.
Yeah.
And the reason I said we pitched it so much is because I legitimately was like, this is just to get the door cracked open for the next one. Whereas before I would say like, I'm too busy for that. Like I don't want to, we already got the money raised, or I need to focus on folks that like would be able to move to this exact opportunity. But no, this was just a lot of just getting the door cracked open. But yeah, there was 20 or so of those pitches where like there's no chance that this we're closing in 30 days. Like this
Yeah.
group is not funding, but I still take the
Yeah.
meeting and pitch the hell out of it, and
This is what
and
you
then
do. You know you
yeah,
do, but the whole thing that I'd also tell people, remember why they passed on you. Remember why they passed. Oh, you're never going to hit those rents. Oh, you're never going to do that. Remember. And as soon as you do it, you blast them. We had a group not take one of our retail deals because they're like, we were going spec on the shop space. Do you know how many times out of like the 100 groups we went to, I'd say 60% of them bailed because they didn't think we were going to get the inline rents. So you know what I did?
victory
I
lap.
was like 13,500 feet. Oh, I have it ready to go this week. I just signed an LOI. We broke ground. Within 30 days, I had 8,000 of the 13,000 leased.
Wow.
And guess what? It was at or above my underwriting expectation. And I basically have now drafted this email letter of just like scheming it all weekend. And I'm like, hey, remember, like you passed on us because you didn't think we could hit the rents as the local operator and guys who actually know the market, and telling you we're so plugged in that you can't just trust CoStar. You can't just trust your online resources. You have to be in the market. And I literally got them rent rolls from my other operator buddies to show them like, dude, these are the rents that are being signed. We just don't want to report them. And dude, I'm so ready to send this email out. And so like, remember, like, feel that like hatred inside. I'm a hater guy. Like, I'm a David Goggins guy. Like, like, all right, just bring the hate in because it's gonna fuel me to perform. And every single time you keep notes of why people passed. This isn't like, oh, he passed, like, oh, this guy's never going to do a deal with me. Like, dude, be the annoying guy that will consistently put opportunities in front of them. And when they tell you why they passed, if it's for a reason that they've been over allocated or whatever, like, okay, different story. But if it's because they challenged your assumptions and you did what your assumptions or exceeded that assumption, make them know. You might not even have a deal in the pipeline that fits them. Just make sure they know. All right. And that will help you actually get deals done in the future because they're like, dude, we passed on this guy. This guy knows what he's doing. Like this is how it's done. And so keep that database, man. That's what I'd say to that.
No, I love it. Yeah, that's very important. I actually have one similar that's
Let's hear it.
going out where we're just updating people on the market. And our example is our 9.9% rent increases on the deal we bought in December that we told everyone we would hit, not to that level. So, similar to your story where we're just want to let everyone know how this is going. So that's actually going out tomorrow. But yeah, that's similar to you. That's funny.
No, but you have to. Again, if you're in the game, you're thinking long term. Like I tell everybody, all these people are like, well, I want to be a developer, I want to be a real estate operator. I always ask why. I was like, do you just want to fight every point of adversity? Like, you wake up thinking like, I want to just fight through it. If your focus is just you want to do it because it makes you money, people like you and I will beat them 9 times out of 10, if not 10 times out of 10, because we think on a longer term thought process, because this is our lifetime career. We've decided this. Whether the goal is passive income, never have to work. Like, no, we just wake up. Like, I see your deals. I love seeing when you close a deal, like either to acquire it or sell it, or your deal stories. Like, I love reading about it. I'm like, oh, hell yeah, Drew, let's go. And I think and I'd say the same thing about you. You're like, oh, dude, that's sick. And it's like, we find fascination over being operators, and the money is a huge part of it, but it's not the end all be all. And I think that's just the difference between guys who really make it and people who don't. And they just kind of fade through the times, because you have to be committed to this game for at least 10 years. I tell everybody, if you want to do commercial real estate, be prepared to make no money for 2 to 3 years. Be prepared. And if you can't, then don't do this business. Right?
Yeah, no doubt.
Yeah.
So, and sharks die if they stop moving. So
I love that
cool.
one.
Well, let's leave it there, Andrew. Cool. How do people get in touch with you?
Dude, check me out on LinkedIn, Andrew M. Dunn 41 with WG Group and VAC Development. You see this beautiful red face there. Or find me on X at Andrew M. Dunn, or shoot me an email for andrew@vacdevelopment.com, or check us out at vacdevelopment.com. Go through the contact form. We'll reach out to you. Always love talking deals. Doesn't matter if you're a $50,000 check writer or a $5 million check writer. I treat you the same. If you want to talk deals or talk opportunities, I'm always there to discuss. And I really appreciate the time, Drew. Thank you.
Thanks. Yeah, I always appreciate the conversation. See ya. Thanks.
See you, man.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcasts. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.